In this video, we'll explain how to invest in the stock market for beginners in 2023. If there's one thing that we learned from 2022 was that the market can be volatile and the ones who were the least educated got burned the worst. So first lesson, don't be uneducated. But just because 2022 was a down year, don't let that deter you. There has always been down years throughout the history of the stock market, but the overall long-term direction is always up. The stock market, along with real estate, has been the two best places to invest money when you look at what has performed in the past. The question is how? How do you go about investing as a complete beginner? Where do you start? What areas do you look? What tactics can you implement? What investments do I make? And what stocks do I choose? These are the types of questions we're going to answer in the video. Also, feel free to click between timestamps if you don't feel that a particular section is relevant to you, or let's say you know a section already. But let's start from the beginning. To know why it's important to invest in stocks, you first need to understand what a stock is. A stock is a business. So when a business wants to raise money, they sell their business to the public on the stock market. This business gets divided into thousands or sometimes millions of equal portions. Each one of these portions is what's known as a share or a section of the stock of the business. So when you own one stock of, let's say, Apple, you actually directly own one small portion of Apple the business. You are now a business owner. Now, I've got a question for you all. What is the purpose of a business? Is it to serve their customers? Yes. To make a useful product? Yes. To make a positive difference in the world? Yes. But let's be honest here. The bottom line, the true purpose of business is to make money. That's a fact. The great thing about this fact is that when you buy the stock and become a business owner, that business is now designed to make you money because you own it. And that is the reason to get into investing, because you can buy stocks, businesses throughout the world which have the sole goal of making you money. Even better, this money is passive. You are not working 9 to 5 to earn it. You are not putting on that suit and tie or high-vis jacket, laboring away to make the money. You can just sit, drink coffee, watch Lionel Messi, the GOAT, play football, or go surfing on the beach, whatever your hobbies are. Investing in stocks is passive, not active income. As Warren Buffett says, if you don't find a way to make money while you sleep, you will work until you die. If that doesn't wake you up and give you some desire to learn investing, well then maybe you should just work until you die. So, how do we get started with investing in stocks? Let me show you the key steps to go through. And just to begin with, I want to say you don't have to be a millionaire to start investing in stocks. Investing is available to the everyday person. You can buy a stock in Disney for $90, Coca-Cola for $60, Apple for $140. The stock market is basically affordable to everyone. So in order to buy a stock, you need to sign up to a brokerage company. A brokerage company is a platform that allows you to buy and sell stocks. Now don't worry, this isn't 1995. You don't need a dodgy broker from Wall Street to do your trades. Go with a well-established company with a proven track record. If you're looking for a very cheap broker and you're just beginning your investing journey, Robinhood and Webull are quite popular. You can buy and sell stocks for free with them. Or if you have a bit more money and you're looking for a platform that's been around for a lot longer, look into one like Charles Schwab or Fidelity or TD Ameritrade. They're pretty easy and straightforward to sign up to if you're living in the USA. Just Google them, go to their website, fill out a form or two, and step 1, find a stockbroker, done. Once you have a stockbroker, you want to familiarize yourself with a couple of terms before buying a stock. 3 key terms to come to terms with. One is a ticker symbol. A ticker symbol for a stock is kind of like a stock's nickname. It's an easy way to find the stock you're looking for. For example, Amazon's ticker symbol is AMZN, Microsoft's is MSFT, Disney's is DIS. So once you've clicked on the stock you potentially want to buy, there are 2 key buy orders you can implement. One is a market order. This is when you place an order to buy or sell a stock at the market's current best available price. A market order generally ensures that you will buy the stock, but it does not guarantee a specified price. Second, you've got the limit order. A limit order is an order to buy or sell a stock with a restriction on the maximum price to be paid. If the order is filled, it will only be at the specified limit price or lower than that price. I personally like limit orders, but it's up to you. Once you have signed up for a stockbroker, you are now capable of buying and selling stocks and forming a portfolio. But now you need a strategy. If you play a game of football, you have a strategy. If you are in a chess match, you have a strategy. If you're buying stocks in the stock market, it's even more important to have a strategy. So you need to choose how you're going to play the investing game. There are 5 broad types of investing strategies that you can engage in. Let me start off with my favorite type of investing, which is value investing. You ever heard of the names Warren Buffett or Charlie Munger? This is the investing style that they use. The fundamental idea with value investing is to buy stocks that are undervalued where the value of the stock is greater than the price you pay. For example, when you go shopping, you like to find clothes or a phone or items that are on sale, right? You want to find a good deal, a cheap price for a good quality item. Value investing is like shopping for deals, but instead of shopping for a new laptop or a new phone, you shop for stocks. There are essentially 4 key steps to value investing. First is you look to understand the business that you invest in. You wouldn't buy a business in your local town before you fully understood the business, its internal components, how it worked, its product, how it makes money, the management who's running it. The same idea goes with a stock. So stick to businesses that you are capable of understanding. This is different for each investor. Some investors will understand gaming stocks more than others because they game themselves. Some investors will understand consumer stocks like Walmart or Home Depot because they shop there often and know which stores are better. Every person has a different set of expertise and group of stocks that they can understand. Once a value investor understands the business, secondly, they look for ones that have a competitive advantage. What I mean by this is they look for businesses that are not easy to replicate. They have things about the business that helps them beat their competitors. Whether it's Coca-Cola's advantage in that everyone knows Coke and loves it around the world, or Canadian National Railway's advantage in their infrastructure setup and railway lines place. Another railway line would struggle to compete because they would have to build a whole new railway across Canada just to start competing. Third, a value investor wants management with integrity and talent. Managers are the ones running your business and controlling the day-to-day environment. If your manager is rotten, this will leak through to the employees and the business itself. Lastly, value investors pay a price that makes sense, one where the long-term value of the stock is better than its price. You wouldn't pay $100,000 for an iPhone, even though it is a good product, but you may pay $1,000. You would love to pay $100. Same goes with a stock. You wouldn't pay a ridiculous price for a quality stock, but you would pay a fair price or a cheap price. Some examples of value stocks include Warren Buffett's investing firm Berkshire Hathaway, Micron the chip company, Alibaba the Chinese e-commerce stock, Meta, Seritage Growth, Occidental Petroleum. Dive deeper into these stocks if you like the idea of value investing and if it makes sense to you. Dividend investing is another way you can play the investing game. If you're a fan of consistent income, you don't want to wait for a stock's price to go up, you just want consistent cash flow, then consider the strategy. Essentially, when a business/stock makes money, they have 2 key options on what to do with it. One is they can reinvest that money back into the business and look to grow it. The second option is to pay out those earnings to the owners of the stock. This is called a dividend. Normally, dividends are paid out quarterly, but you can also find ones that are paid monthly. A big thing to watch out for though with dividends is consistency. Some stocks will always pay their dividend. Some stocks, a recession will come, their business will get hurt, and they cut their dividends. They're inconsistent. One way you can mitigate a potential dividend cut is by buying what's called dividend aristocrats or dividend kings. Dividend aristocrats are stocks that have consistently increased their dividend each year for 25 years or more. These include IBM, Exxon, Chevron, and general dynamics. Dividend kings are stocks that have consistently increased their dividend each year for 50 years or more. These include Coca-Cola, Colgate, J&J, P&G, and a range of other quite mature companies. These stocks, as history shows, are very unlikely to cut their dividends in a recession or in tough times. They haven't done so for 50 years. Now, some good dividend investors to follow are Dividend Sensei on Seeking Alpha or PPC Ian and JJ Buckner on YouTube. If you're lazy, or not even just lazy, you just don't have the time to go about researching stocks, then you may want to consider passive investing. A lot of beginners think passive investing will not get you good returns, but this is untrue. Passive investing in index funds actually beats 83 to 95% of active money managers. So let me quickly explain what passive investing is. Passive investing is when you buy large groups of stocks called index funds or ETFs. Instead of actively picking out individual stocks, you can buy a whole group of them. For example, you can buy the S&P 500, which is 500 very large USA companies. Or you can buy technology index funds if you think that sector will do well. Or you can buy emerging market ones or energy ones, or depending on the sector that you like. ETFs and index funds are a really good way to diversify your portfolio and spread your risk. In fact, this might interest you. Warren Buffett recommends that most investors adopt passive investing in index funds instead of other strategies.
I mean, I am happy to tell people that the same thing I've told them before, but they'll never get the message, most of them, but a few do, that the most, best thing to do if you want to invest for the long term
is index.
And it's the S&P 500 index.
Right.
Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942, shortly after Pearl Harbor. I spent $114.75. Three shares, $114.75. If I put that $114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today.
Oh man.
The answer is about $400,000.
Oh.
This investing strategy is for the more illustrious type, the guys who don't mind a little bit of risk. It's like the attacking style when you play a game of chess. Growth investing is where you invest in companies that have more risk to them, yes, but have more potential on the upside. The innovative stocks, the technology stocks, the disruptive stocks that are changing the world, the Teslas of 10 years ago. And growth investors have done very well over the past decade as the world has changed and as technology has spread. Growth stocks like Amazon, Apple, Tesla, Netflix, Alphabet, Meta all shot up like a rocket. The key with growth investing is to weed out the good growth stocks with a proper business model from the junk, because there is a lot of junk. Also, you want to try and invest at the start of the bull market instead of at the end of the cycle. And this is why I'm kind of a little bit wary of growth investing at this point in time, as we have experienced already a long bull market, and that bull market is going through some turbulence, we can say that in the least. Cathie Wood, Chamath Palihapitiya are two investors who do follow a growth-oriented style of investing. Although they did well to start with, they have struggled a lot this year, especially Wood. As we can see, her fund ARK Invest started with a bang, but it is now broken even. It's at the same price that it was a long time ago. Be wary when you adopt this style of investing, because this style will struggle the most if the economy continues to be on edge. While growth investing struggles when the economy is unstable, volatility investing thrives. People like Michael Burry from The Big Short love these types of conditions. I'm not sure if you've watched the movie The Big Short, but essentially in that movie, Michael Burry shorted the housing market in 2008 and made a bunch of money as the market fell. Michael Burry profited from volatility. Volatility investing, you can either do the Michael Burry approach and short stocks on the way down, or you can do the George Soros approach and ride stocks on the way up. He also short stocks on the way down, but he does ride stocks on the way up. This approach can be quite risky, and you need to have your finger on the pulse at all times, but if done right, it can make a lot of money. Those are the 5 styles to investing in the market. If you want to see the styles that I personally implement and the way my portfolio looks like, there is a link to that in the description below for premium viewers. Have you ever been on those stock websites and you see hundreds of ratios and numbers everywhere on a screen? Yeah, it can be pretty confusing for an experienced investor, let alone a newbie. So let me explain some key ratios and numbers to know. If you understand them already, skip to the next one. A good test for you all to do is how many of these 12 ratios and metrics do you already know? Okay, tick them off the list as we go. So price per share or price per stock simply tells you the price that will cost you to buy a share. Pay that price with your stockbroker and you will become a shareholder. The market cap of a stock tells you the total value of the business. Market cap is calculated by getting all of the shares in the business and multiplying it by the price of those shares. For example, Apple's market cap is $2.3 trillion. So if you wanted to buy the entire business of Apple, you would need $2.3 trillion. Tesla is $525 billion. Netflix is $140 billion. The dividend yield compares the price you pay for a stock to the yearly dividend it gives. So if the dividend yield is 1.5%, like it is with Walmart, if you bought $100 worth of Walmart stock, each year you would receive $1.50 in dividends. Right now, the average stock on the American market has an average dividend yield of 1.66%. So use that as your benchmark when looking at dividend stocks. If you ever see the letters EPS, that stands for earnings per share. Earnings is the same as profit, aka revenue minus expenses. Obviously, you want earnings to be as high as possible. Get the most profit, the most money as possible. The PE ratio is one of the most important ratios to know because price in and of itself is not important. Price relative to profit is very important. The PE ratio compares the price you pay for a stock to the earnings that stock brings in. All else remaining equal, you want the PE ratio to be as low as possible. If you have a PE ratio of 6, that means if earnings stay the same for 6 years, you will get your money back after that period. You'll get your money back in 6 years. The price to book value compares the price you pay to the book value you get in return. Book value is the value of the stock on paper. If you were to sell all of the assets of the business and pay off all of the liabilities, the book value is what's left. You want the price to book value as low as possible. Back in the day, Warren Buffett used to buy stocks that had a PB ratio below 1. This means he could buy the entire business, sell it off, and also make a small profit because the price he paid was less than the net assets of the business. He used to call this the cigar butt approach, where he would find a smelly, used cigar on the ground, smoke the last puff of it, get that final bit of value, and then discard it. Remember, as I said earlier on, that a business's main goal is to make money. One way to judge how good they are at doing this is by looking at return on equity. So equity equals assets minus liabilities, basically how much money is in the business in terms of net assets. Return on equity is the percentage return in profits you get on that equity. If you have a high return on equity, it means that the business can get money and generate it into more money at high rates. It means basically that it's a good business. I recommend a stock to have a return on equity of at least 10%, and Buffett likes return on equities above 15%. You can find the return on equity metric by going to Yahoo Finance, go to the statistics section, and scroll down to return on equity. The price to earnings ratio, as I said before, it's a great metric, but it's missing one key component: the growth of those earnings. This matters because if earnings are going to double each year, it affects the value of the stock and the return that you'll get in the future. The PEG ratio takes into account growth of earnings. It is calculated by dividing the PE ratio by the growth rate of earnings. And just like golf, you want this number to be as low as possible. The lower the PEG ratio signals the cheaper the price, the higher the earnings, and the higher the estimated growth. You can find the PEG ratio by going to zax.com, go to fundamental charts, and click on the PEG ratio. Also, a lot of these ratios in general will come up when you type in the stock and the ratio that you're looking for on Google. Funnily enough, Google has the answers to a lot of things in life. As a business owner, two of the most important metrics to look at is one, revenue, aka how much is the business making in total, and two, earnings. After I deduct expenses from the revenue, how much do I actually keep? You want both of these numbers to be obviously as high as possible, consistent, and also very important, growing. Yahoo Finance gives you a nice overall picture so that you can see what's happening with these numbers. The green is revenue, the blue is earnings. Okay, so this is Apple stock. As we can see, both have grown nice and consistently, did very well in 2021, but also slowed down slightly in 2022. Also, you can go and check analyst estimates for how much they expect revenue to grow by in the future, and you can check how much earnings are expected to grow by if you go into the analysis section of Yahoo Finance. Yahoo Finance is a very good website for investors, by the way. Now, if there's one thing that we learned in 2022 is that debt is a dangerous game. Just go ask Sam Bankman-Fried, Credit Suisse, or Evergrande. They'll tell you how much trouble debt can get you into. If you get into too much debt, things can all come crashing down. But how do we tell how much is too much? There are two key ratios to look at to assess a company's debt level. First is the debt to equity ratio. This ratio compares how much debt the business has to how much money or equity the owners actually have in the business. Naturally, you want more equity than debt. The current ratio is also very important because it gives you a clue if the business can survive in the short term. The current ratio is a business's current assets minus current liabilities. So current assets are all of the assets that can be made liquid into cash within a year. Current liabilities are all liabilities that must be paid off within a year. What happens when you have more current liabilities than current assets? Your business is doomed to become insolvent. Warren Buffett, he likes a current ratio of at least 1.5, aka current assets are at least 50% more than the liabilities in the business. This ensures that they are solvent and sound in the short 1 year term. The economy is made up of sectors and industries. You want to pick out the sectors that will perform over your investing horizon. The economy has 11 key sectors. One is the technology sector. This includes stocks like Apple, Microsoft, Nvidia, IBM. Two is the financial sector. This can be banks like JP Morgan or Wells Fargo. It can also include insurance stocks like AIG and Chubb. 3 is communication services, stocks like Google, Meta, or T-Mobile. 4 is consumer cyclical. These are businesses that sell non-essential goods. Amazon, Tesla, and McDonald's come under this sector. But if you ask me, come on, McDonald's is pretty essential. 5 is consumer defensive. These include companies that manufacture food, beverages, and other essential items. Walmart, Costco, Target all come under this category. 6 is the healthcare sector. I'm guessing we all understand healthcare and the types of companies that would fall under here. 7 is industrials. These are businesses that aid other businesses in manufacturing, shipping, or producing products, like the Boeing company makes planes for airline companies to use. 8, you have the real estate sector, obviously based around buildings, both commercial and residential. 9 is energy, so oil and gas companies. 10 is basic materials, companies that work with raw materials. And 11 is the utility sector, like electricity companies and water companies. Okay, now take a look at all of these sectors. Which of these do you have a somewhat decent understanding of? Which sectors do you think will perform the best over the next 3, 5, 10 years? Weigh up your options and start building a portfolio in the sectors that you can make sense of. So I just want to say congratulations if you made it up to here in the video. You've actually put in some effort and you've not just clicked off and you've watched some, I don't know, what do people watch online? Cool dance videos or whatever. Now, before you go out and buy a stock, you really want to learn how to study a business. Remember, a stock is a business, so before you buy, learn it well. So let's say you're looking at buying Apple stock. Okay, now I need to learn, how does Apple make money? They sell iPhones, they sell their Macs, they sell wearables, they have their services section like Apple TV, iCloud, and Apple Pay. If I buy the stock, I own Apple, so how will these income segments do in the future? Will more people buy Apple products? Is the wireless headphones doing well? How are their watches doing? Think like a business owner and ask these questions. Look at consumer behavior and what your friends are buying. What products do your friends like? What businesses are benefiting from the products they like? Just be that nerd who debates others on the value of a stock, on how good businesses may do in the future. Instead of overly focusing on politics or things that don't affect you as much, learn business. It's going to help you so much more in life, and it will help you with your investing and your net worth. The market is a crazy thing. One year it's running hot and you're making money in every stock that you buy. The next year a recession has come and most of your stocks are down. This is the nature of the market. You need to make sure that you're in control and not the market dictating you. What most investors do is they allow the tide of the market to suck them in and then spit them out, and they often tend to lose money. They get drawn in as prices get higher and higher. They become greedy, and when the market falls, they panic, sell, become irrational, and they lose money. One way to avoid this is by having a game plan. The market will behave erratically. It's very hard to predict. So if the market goes up, what's your plan? Is it to potentially sell for higher prices, or is it to just hold your stocks? If Jerome Powell raises interest rates and a recession comes, what will you do? If other investors panic and sell the stock that you bought, will that affect you? Will it affect your style? If there's another lockdown and businesses close, will you keep buying stocks? These are the type of questions to answer because it's vital to be prepared for what the market might throw at you. Be rational while everyone else is being emotional. The worst thing that you can do is get overwhelmed by all of the information and just give up on making your first investment. If you are overly meticulous, you'll end up waiting forever, inflation will eat away at your savings, and you'll stay poor. Even if it means slowly starting with passive investing in index funds, dip your feet in with a little bit of money so that you can start learning the game. It is a fun game. It is fun to make money, but start small and play the game wisely. So that should give you a good overall idea of how to get started in the market, some strategies, some ratios to look for, and some simple guidelines to follow. Remember, if you want to go more in depth into the investing world, you can sign up to the Investing Academy, where we look deeper into what experts are buying, my stock portfolio, and teach you even more about the investing game, because investing is important. If you don't learn it, you're going to find it very hard to get or maintain wealth. And if you don't have wealth, then you have less freedom to do what you want in this world. I love the game of investing. I don't know if you guys do, but I hope that you'll learn it more and end up loving it like I do, and I hope it makes you a lot of money.